guess we'll record this in case somebody actually wants to listen to it later, or somebody who's not here wants to listen to it. Okay, so let's talk a little bit about, oh, your test. You guys got the email from me that I didn't mean to give you 7%. If you looked up a table for 7%, that's fine. You know, that's okay. That's cool. But I didn't mean to do that to you. I didn't mention in class, but I didn't mean to do that to you, and I did it. Yeah. So anyway, figures. And then if you have already done the test, that's fine. I don't think it's an advantage you did today. If you haven't, obviously, you know, do it later. Whenever you do it, get it back. I got a couple of them. Anybody else do it? Yeah. You might want to give me the scrap papers that relate to scrap papers. Scrap papers that relate to scrap tap in. So when I'm ready to down, I can search for it. Yeah, if you got it done, I'll try to get it back to you when I come back on Monday. And if not, obviously, get it fixed. Okay? Anyway, I know I mentioned to you that you could have more time if you wanted, and you guys seem very interested, but I really just email me saying, have more time. Did somebody do that to me? Okay, anyway, so let's start with notes that have no stated interest rate or have a nominal stated interest rate. If you take a look over on page 361, 361, they say zero interest-bearing notes. Is there such a thing as a zero interest-bearing note? Of course not. Nobody loans money without charging you interest. So if it's a related company, you might have that situation, and if they didn't really loan it to you without interest, right? They just, you know, built in suffice whatever they're selling you or whatever, or it's just related to the company stuff. If it's a vendor or a customer, it's just an adjustment to the sales price or the purchase price. It just is. Okay, depending on which side you're dealing with. Okay, so they show you an example of zero interest bearing. Let's do nominal. So we do the same thing with nominal. Zero interest bearing interest, zero interest rate. But let's say there's a 2% interest rate and the effective market rate should be 10%. So let's say it's a $10,000 loan, and we'll just make it a loan. It could be a sale and you do the same thing, or a purchase, you do the same thing, you just discount, right, the note, and that's what the sales price is, or the purchase price is. Okay? But let's say that they're loaning us money, okay? No, let's make it a sale. I take it back. Let's make it a sale. $10,000, okay? And it looks like the sales price is $10,000. But let's say they have 2 years to pay, and let's say that their stated rate on it, just like on a bond, stated rate is, this is the term, stated rate is 2%, and let's say the market rate, effective rate, the rate implicit in the deal, is 10%, okay? So, and let's say that we're selling services, so we don't have cost of goods sold. You'd have to record cost of goods sold, okay, if it was a product, goods. So, somebody want to tell me what that's worth? What do you do? What do you do? And let's say they're going to pay the 2% interest every period, okay? We're going to pay the 2% interest every period. It's only 2 periods to make our math simple. What is this thing? Present value of the sum, 10,000, and present value of an ordinary annuity of 10% of 10,000 or 1,000, 2 payments, right, guys? Isn't it? Okay, you immediately recognize these now. You need to get so you do. Okay, when you run across something where cash flows are over time, you got to discount it back to now, always. Okay, so what I've got is a future value, 2 periods from now, of $10,000. Everybody agree? Times 1 over 1 point what? 10%, 2 periods, right? Just discount it for 2 periods at 10%. What's the factor of 2 periods at 10%? That'll give me my present value on it. That's of the $10,000, right? That's going to be paid at the end. So what's that factor? 10% 2 periods.
0.82645.
Sound right? Okay. Everybody make sure the is the right square, basically, right? So each of those dollars are worth 82 cents. 8,264.50. Is that right? Sound good? Everybody agreeing? And then what else is there? It's an annuity payment, right? Okay. How much is the annuity payment, we said? How much is it a year? I'm sorry, it's not $1,000. It's 2%. 2% of 10,000 is how much? Not 1,000. 200. Yeah, 200. Sorry about that. It's $200 twice, right? So we got to value that thing, huh? Okay. And if you have more periods, obviously it has more effect. And then what's this? This is an ordinary annuity payment. It's at the end of the period. N equals 2. Interest rate equals what? What are you going to discount it at? The market or effective rate. Sure. Okay. You guys have done these things over and over. We're using the same thing. That's why I kind of like to show you this, right? Is we're using the same stuff to value these. Doesn't matter if it's a note receivable, note payable, bond, everything's this way. Okay? Just future cash flows. What's the factor for that? 2 periods at 10%.
1.73554.
Take that times $200. How much is the $200 twice the $400 worth? Right now.
$347.10.
Okay. How much is the whole note worth? How much did you loan, I guess, if you're selling stuff, right? You loaned it out. For buying stuff that you borrowed. How much is that?
2,611.46.
Okay, good. All right, now let's do our journal entry. Everybody got it? That's what the deal is. That's my sale price. Okay? Now there's 2 ways that you can record the note. You can either do it at the gross amount and show a discount, or you can just show it at the net amount. Doesn't make any difference. What you're going to put in your balance sheet is the net amount anyway, right? Okay, so let's do it at gross. Let's say we're going to record it at gross. What would be the journal entry? Okay, how much is my sale? This is service revenue. I said it was a service we're selling, or if it's product I'm selling, it'd be sales revenue, huh? Service revenue, $8,611.60. Okay? What's my note receivable? 10 grand. And what's the difference? Looks like $388.40. Is that what that is? My fast math skills, did I do it right? What do you call that thing? A discount. Oh, let's add a 1. Yeah, okay. 13. Okay. 1,388.40. 10% interest. Yeah. Okay. 1,388.40 discount on what? Note receivable. Or, like I said, you can just show the note receivable at the net amount. Does that make sense? You're going to amortize the discount either way, okay? Over what period of time? 2 years. Okay? So now, let's do our first journal entry. What would the first journal entry be? So if this was on January 1st, year 1, let's just make it easy so that we have no accruals. You'd have to do accruals at the end of years, wouldn't you? Right? If it wasn't exactly on the calendar year. But it's the same concept. January 1st, year 2, what happens? That's when actually, December 31st, year 1, whatever. A year later, what would you do when the interest is paid? How much interest are they going to give you? Yeah, debit cash, $200. I like that. And what are we going to earn? Interest what? Revenue. Excellent. And what are we going to amortize it for? Discount on notes receivable. Everybody agree? You guys are staying with me, aren't you? Okay, now what? Calculate your interest revenue and you'll know what your discount is, right? What your amortization of the discount is, just like on a bond. Okay, how much did we loan them? Don't think about it too much. How much did we loan them? No, we didn't. $8,611.60, right? That's what we loaned them. That's what the sales price was. That's what that note is worth. That's how much you loaned them, right? times what for interest? You're going to use your 10% effective rate, right, everybody? They're paying 2%, but they're really incurring 10%, right? That'd be their interest expense. That's going to be our interest revenue, right? Okay, what's 10% of 8,611.60? $861.16. Okay, so what's that going to be? Credit to what? Interest revenue. 861.16. And then what else is going to happen here? Yep, amortization of the discount is 661.16. Okay, at this point now then, what's your carrying value on this note? I've got a note receivable of 10,000, don't I? Everybody agree? I have a discount on the notes receivable. How much? 8,000, whoops. Come on, Keith. 1,500. Let's not do 8,000. It was 1,388.40. What would you just do to it, guys? You just debited for 661.16, didn't you? What's left? Okay, now what's my carrying value on this note? What's my new carrying value on this note? 10,000 less 727.24, right? Everybody agree? That's what would be on my balance sheet. How much is that? 9,202.76. Great. What's my interest rate the next time? So January 1st, year 3, or December 31st, year 2, whatever it is. Right? What's my interest rate still? 10% it is, isn't it? How much is that going to be, everybody? $927.26? 28 cents? Okay, let's do this one then. That's my interest the next time. So how much cash am I going to receive? See why I only made it 2 periods. How much? 200 bucks. What's my interest revenue? You got it. And what is my discount amortization? Yeah, well, we need it to be 727.24, so I hereby decree that's what it is. That's a 4. Okay? But that's what it'll do, right? That's rapid. Everybody good? Okay. So easy, huh? Now what will happen? Of course. Probably on the same day. They're going to give you the $10,000 too. So it's really $10,200 they're going to give you. Am I right? And what are you going to credit? Notes receivable, of course, for the 10,000. So I just wanted to quickly show you that. Work through a couple examples like that, huh? Doesn't matter if it's 0 interest bearing. They show the example they give you in the book is 0 interest bearing note, right? Well, there's no such thing as that. But there's also no such thing as a 2% when market's 10 or 12 or something. Okay? And if there's stated interest, big deal. You just got an annuity to go with it, right? Doesn't make much difference. It's not calculations. Okay, cool. You guys can do that. And that's going to work for note payable, it's going to work for note receivable, it's going to work for sales, it's going to work for purchases. By buying equipment, right? The equipment would have cost whatever the present value is, right? Always calculate the discount. Okay. Okay. Handle that fast. Okay. Fair value option. Over on page 365. All right. What's the deal with this thing? Fair value option, everybody. What do you think? If you want, you can do what? You can record these things as what? Fair value. Yeah, you can adjust the fair value. Europeans love this, right? Okay. International Financial Reporting Standards. They love this fair value stuff. And we're a little slow to adopt it. Well, we do it for a bill for sale, securities, and we do it for trading securities, right, guys? You guys know this, principles again. Okay, and when we do it later again, and then you get not this class. Okay, so what's the deal? If you adjust the fair value, what's going to happen? You'll gain or loss. Adjusting the value. Where does the gain or loss go? Notice on page 365, they show the debit to notes receivable and the credit to unrealized holding gain or loss. It's unrealized because I didn't sell, or I didn't collect the note yet, or pay the note yet, depending which side of the deal I'm on. Right? What's the deal? Unrealized holding gain or loss. Shows right there where it goes. What does it say? To the income statement. So is it under comprehensive income or is it on the income statement? It's on the income statement. Okay? So this is serious stuff, right? Those gains and losses are in the income statement. All right? You know the difference, right? What do you do with trading securities? Where does the gain or loss go? The trading security. Change in market value at the end of the year compared to when you buy it. No, trading security. I'm going to only hold it for a few weeks maximum. So I think it's going to trade real soon. That's why I call it trading security. What's the deal? That's going to hit the income statement. What if it's a bill for sale, short term or long term? Short term, I'm going to hold it for more than a few weeks, up to a year. Long term, I'm going to hold it for more than a year, right? Now what? Now the gain or loss goes where? We still adjust the fair market value, but the gain or loss goes where, guys? Now that's the right answer. Other comprehensive income. Okay, it's a big deal. So most companies decide they don't have trading securities. So they don't mind the gains hitting their income statement, but they don't want the losses. What causes these gains and losses? The market value changing, right? Well, the market value bounces around, right? How much riskier would a company look if they take all those gains and losses and put them on their income statement, and the income statement's bouncing up and down? What happens to their beta? They don't want that beta bigger. Right, guys? You just did one of the high beta. Man, the cost of capital is way up, doesn't it? Okay? So they try to smooth their income. Legally smooth it, I guess, or within generally accepted accounting principles, whatever that even means. Right? But they like their income not to bounce around too much. So certainly we don't like fair value very well. I know it's not a big deal. Okay? In fact, it's much. But that's the deal anyway. One key thing. You can adopt this if you want to, but if you do, can you get rid of it? No. Once you adopt it, you've got it. Everybody got it? Once you do the fair value method, I bet you see that in the CPA exam because it's very new and it's kind of different. Yeah, that's all. Yeah. Right? Once you adopt it, you're in. Okay? You got to use it. But you don't have to adopt it. Okay, gang. Ways that I can get money out of my accounts receivable. What are ways I can get my money out of my accounts receivable? There are a variety of ways I can do it. What can I do? I can use my receivables to do what? Somebody owes me $1 million, or a variety of people owe me $1 million. What could I do? Use it? What? Yeah, just use it as collateral. And what does that mean? Collateral for the debt. I just do what?
You don't pay them, they take that.
Yeah, they take that. Okay, so I pledge it basically, right? I put a note in my financial statements that it was collateral for the debt. I get a better interest rate, or maybe get them to loan me money at all, right? Okay? If I wanted to go borrow money at a bank, and I wanted to borrow on my signature, and I wanted $10,000, what's my interest rate going to look like? If they'll loan it to me. I'm not going to tell you what I'm going to use it for, and you can have no collateral. I'd like $10,000, please. What are they going to say? Yeah, they might just laugh at you, right? But they might give it to me because I have a little bit of wealth, right? Will they give it to you guys? No, they'll really laugh at you, okay? They don't want you to have a cosigner, huh? Right? They're going to guarantee it. Okay, so, but even then, they charge me a high interest rate probably. What if I gave them some asset as collateral, where they could go get that asset if I don't pay? Interest rates going down, yeah, and they're more apt to loan to the money. So yeah, collateral will help. But you know what? You just put in your notes of financial statements that your receivables are pledged as collateral for the debt. Can you use them as collateral to borrow money again? No. So do you ever want to give up your assets as collateral for debt until you have to? What if you got an operating line that's not unsecured? And you get a decent interest rate because you're a healthy company. Will you do that? What I mean by unsecured is there's no collateral. Sure. Right? What do you do then if the credit gets a little tighter and, you need collateral? Well, you give them your receivables, you give them your inventory, whatever, but you can't use them to borrow again. So you have less flexibility, less financial flexibility running your business, sure. Okay, so with this one, all you're gonna do is just record the loan. They give you the money, you debit cash, you credit notes payable, big deal, right? Okay, if you're lending money, you debit notes receivable and credit cash, big deal, okay? Unless it's discounted, we already did the discounting. By the way, you can go to the bank and have it discounted too. They take the money up front. They get their interest up front. It's a higher interest rate for you, really, if you borrow less. Okay? All right, we'll mess with that later. All right, anyway, so there's collateral. That's one way. You use your receivables as collateral. What else could you do?
Selling receivables.
Yeah, you can sell them, okay? And sell them, there's two ways we can sell them. What would it be? What do we call it? One's factoring, and the other one's factoring. That's clever. Factoring and factoring, but there's two different kinds of factoring. Factoring is selling them, guys, to a factor. Told you we were going to cover these today. With recourse. And without. That's not too hard. You need to know what the difference is between. That's selling them. What does with recourse mean? If you don't pay, no, you're borrowing money, or not borrowing, you're selling your receivables, right? But if they don't get paid, I'm sorry, not if you don't, if they don't get paid, if the receivable doesn't get paid, whoever bought the receivables from you, with recourse, what does it mean? They can come after you. They can come and get us, right? Okay. What's without recourse? Once we sell them, we're done. The risk transfers completely to them. By the way, if I'm completely broke and I'm selling my receivables, does the factor care very much if it's with or without recourse? If I have absolutely nothing, probably not. Okay. But there's a little more risk for them, a little less risk for me. So guess what's going to happen to the cost of doing it? What's going to be more expensive? Factoring without recourse is going to be more expensive than factoring with recourse, isn't it? Right? They're going to want more. Well, that's going all the way to selling, though. So here we had using it as collateral, and then we have selling it. Okay, fine. There's something in between. What's that? I'm still borrowing on the one in between. But it's not just collateral now. Because with collateral, when I collect the receivable, if all I've done is pledge my receivables as collateral for the debt, when I collect the receivable, I don't have to give the money to the people I owe the money to, right? Does that make sense? I don't have to pay them with that cash. They just have the receivables as collateral. Does that make sense? So if I collect the money, I don't have to send it to them. But there is something they could do to wrap it up so that when I collect the receivable, I have to give them the money. Or maybe even they'll collect the receivable instead of me if they really don't trust me. Okay? They think I'm really a poor business person, or they maybe a little shady. And I might not send the money when I collect it. I might use it for something else. What do we call that? That's assignment. So an assignment is still a loan, okay? I am still borrowing money, right? But I haven't just pledged the receivable to them. As I collect the receivable, I give them the money. Everybody got the idea? Or again, we could set up the assignment whereby I have my customers pay them directly. And then they'll collect what I owe them, and then anything over that they'll send to me. Everybody got it? So you need to know those three areas. Well, actually four, I suppose. Because there's two types of factoring. So this is pledging my receivables. But both of these, key thing, both of these is I am borrowing money. Okay? That's a critical distinction. It'll drive you nuts otherwise. I am borrowing the money. Here, I am selling the receivables. Where will you have a loss? Won't be a gain. Where will you have a loss on selling your receivables? When you sell them on factoring. Where will you have interest expense? When you borrow. Oh, and when you look at this chapter, you look at all those different methods, That's what's going on, okay? So let's take a look. Here's borrowing. First, maybe we'll make an example. Here's borrowing. Borrowing, they're going to do transfer of. No, they should. On the top of page 367. Okay. That's secured borrowing. Yeah, okay. So what they've done is they've borrowed money, right, from the bank. Bank has a note receivable, we have a note payable. And what are they doing in terms of this interest? That's kind of an interesting one. Did you take a look at that? What are they doing in interest? They're assigning, this is an assignment. What have they done? What's that interest expense on the day of transfer? What does that mean? What's the bank doing to it? By the way, what's the cheapest way to borrow? Pledging. What's next cheapest? In other words, more expensive, because that next to the cheapest. What do you think? Getting worse. Getting more expensive. Assignment. What's the most expensive? Factor. Who factors their receivables? I can't pay my bills. I can't pay my payroll. I can't buy my inventory to sell it to make any profit. And what do? I sell the receivables. I can't collect them in time to pay my bills, right? And nobody will loan me any money anymore, right? I'm on the ropes. People who are constantly factoring over people. And so the fees are horrendous. When you look at these percentages in there, the interest rates are just massive. It's not an interest rate, I guess, it's just sold. But the cost of getting some cash out of receivables is horrendous. You don't want your business to go here, right? What you want to be doing is borrowing money, right, at a reasonable interest rate. But you know what, on this assignment, they're getting more interest out of them too. How are they doing that? How does the assignment deal work? Notice under secured borrowing on page 366, it says to illustrate how Howard Mills provides assigned 700 of its receivables to Citizens Bank as collateral for a $500,000 note. What? They need $700,000 receivable as a collateral for a $500,000 note? That to begin with. And then what they do is they're charging them 1% of the accounts receivable. They're not charging you 1% of the $500,000 they're loaning you. They're charging you 1% of the $700,000. And you're not a very good credit risk here already, right? Getting the idea? So they're taking $7,000, and then what they do is they take the $7,000 out of the $500,000 before they give you anything, and they only give you $493. And they take it up front. You only borrowed $493,000. Everybody agree? Okay, so you borrowed $493,000, and you were going to pay them back $500,000 plus what? 12% interest. This is getting pretty ugly, isn't it? You have the idea? This is a lot more interest than it looks like. Okay? And we can calculate how much interest it is, can't we? Take the time and the amount that you gave them. You're going to give them $7,000 plus another, how much interest do they give them later? $5,000, I guess? And then another $660. So getting the idea? So it's $5,000 plus $7,000, $12,000 of interest for a year or so. Okay? I think it was a year, wasn't it? Or was it even less than that? How long was their term? Was it monthly? Yeah, maybe it's a month. Okay, maybe they put dates on those there. Okay, so what's the deal then? Take a look at how it builds in Citizens Bank. Debit cash for what they gave you, debit interest expense, because that's what it's going to be for the upfront interest, and credit notes payable. And the bank has a note receivable, interest revenue, and cash. And then you collect a bunch of money. And if I collect the money, who owns the receivable? I still do. Right? Oh, by the way, you could do one other thing. They didn't show it there. But what they could do is they could debit assigned accounts receivable. You'll see this too. This is fine. Debit assigned accounts receivable for $700,000. and credit regular accounts receivable for the $700,000. And then as I collect these, I'll credit assigned accounts receivable. Does that make sense? And after the whole deal's done and I've paid them off, I'll get rid of the rest of the assigned accounts receivable and put them back into regular accounts receivable. Why would I want to do something like this? What do I like about this? I keep track of it separately, and on my balance sheet I tell people how much of my receivables are assigned to somebody, because I can't borrow any money with them, right? I can't do anything with them. Until this loan's paid off, those assigned receivables effectively belong to the bank. That makes sense? So they're collateral, but also as I collect the money, it has to go to them. Not all of it, right? Just the first 500 plus the interest. Got the idea? It's gonna work, so no big deal. Once you understand the business deal, it's not bad. On the second entry there on page 367, what happened? I collected $454,000 of the accounts receivable, I guess, and what's the deal? The sales returns, okay? I'd only got $434,000 cash. The sales discounts of 6, so I collected $440 plus the discounts. And there's the sales returns. Who's responsible for the sales returns and allowances and the sales discounts here? Obviously, people that sold the product, okay? Okay? And then we collected the money. What kind of entry would the bank have, of course, seeing as nothing happened? See, they had no entry there? Of course not. The receivable, we collected it. Okay? If we're selling these, if it's factoring, it's going to be the reverse of this, right? Okay, we're going to have an entry and they're not. Okay, that's all. Okay, anyway, so keep track of where you're at. By the way, what if we have it set up for the bank to collect the money? What would happen? Then they'd have the entries, right, and then they would remit the difference to us, whatever's left over. Okay? So, no big deal. All right, so no big deal. And then we're going to send them their money. So we collected $434,000. So notice I'm sending them the third entry there. I'm sending them the $434 plus their interest. Where do you get the $5,000 interest? We borrowed how much? $500,000, 1% a month, right? So that is 1 month, okay? So I'm giving them $5,000. So how much have I given them for 1 month on a $493,000 loan? Well, they gave me $493, right? I haven't paid it all back yet, though. But how much interest have I given them so far? I've only paid $434 out of $493. How much interest have I given them so far? $12,000. 7 up front and then another 5. Take 12,000 divided by 493. What's my interest for the first month? 1 month. What percentage is that? 2 point what? Yeah, take it times 12. You want to borrow money this way? Wow. Yeah, wow. Oh, yeah, already. Factoring first. Okay. Yeah. All right. So you get an idea who these folks are. Right. Situation here. Okay, and now how much do we owe them if we're paying $434,000 plus the interest? I had to give a 5 somewhere else, right? Okay. And you can see the bank, credit staff, credit interest revenue, credit receivable, sure. How much do I owe them? 500 less the 434, right? So I still owe them how much? 66, and what am I going to do then? Take 66,000 times my interest rate, and it's $660 in the last one. See that? Everybody see where they got it? It's no big deal. Okay, the next time we collect $244,000 in cash, and there's a write-off of bad debts of $2,000, that's fine, so it goes against the allowance. Accounts receivable goes down by 246. So what we've done is we've taken the 454 out and the 246 out, right? And we're done with the deal, right? Everything's good? Okay. So if I had assigned it the way I did up here, what would I have to do now? I'd still have $200,000 that I would need to do what? Debit accounts receivable and credit assignment accounts receivable. So not a big deal, right? Okay.
Well, we just run that entry just because it's money you essentially never received.
Well, I'm never going to pay them the other 200. I'm only going to pay them the first 500. That's the thing. Whatever's left in the receivables, like the idea of total that. So I'd only have the assigned accounts receivable as long as I have the debt. Right? What's sad though is companies get in a situation where they're doing this, and guess what they do? They keep doing it. Same thing with factoring, we never get caught up. With factoring, you usually go bankrupt, right? Then you just keep going and going until you just don't have anything to sell, right? You receivables to sell. So they're selling the product and you're selling the receivables too, right? Yeah, not a good situation, you know. Don't be undercapitalized if you ever start a business. And that investment up front, right? You can finance your receivables, finance your inventory, keep going. Okay, so anyway, that's the deal, guys. Easy, kinda, crank through that a little bit, look at it. Let's look at factoring. What's happening with factoring? What happens to you when you factor? Take a look over on page 368, 369, and there's some really good problems that you can do, exercises and problems you can do here. What does it look like without recourse on page 368? What's the interest look like? Well, interest loss, we call it, but it's really what we paid to get our receivable out. This time, we're not going to assign anything to anybody, right? Assignment is still, you saw that, right? Assignment is still a note payable and a note receivable to the bank, whoever we borrowed the money from. What's factoring? Take a look at those entries on page 368. What's factoring? It's sold on receivables, right? Those in crediting accounts receivable? So whatever amount of the receivable I factor, I'm going to credit accounts receivable for. Okay? It looks pretty straightforward, but look how little cash we got out of those receivables. You know, 500,000 yielding 460 in this example. What's 40,000 divided by 500,000? How much should I give away? Yeah, up front. Okay. Now I might get more if what? My customers pay everything. My customers pay everything, I may get more. What if my customers don't pay everything? Oh well, I'm done. Okay? And if it's without recourse, as this one is, right? This is the one without recourse. I'm not on the hook anymore. So how about if my customers paid them less than the 460 cash that Commercial Factors gave me? That's too bad. Yeah, I won, they lost. They'll never do business with me again, but you know, it's okay. Right? I'm off the hook. But if it was with recourse, they'd come after me for whatever's missing. Make sense? Not too bad. Okay? So, take a look at the entry there. How do you get those numbers? What are these things? Press textiles and commercial factors. Let's take a look at what's happening here. What are these? So the textile company, right, versus the factory. The ones selling their receivables, right? I mean, they're debiting accounts receivable and crediting sales, right? Just like everybody. And then they take their receivables and they sell them to the factory. So they're getting rid of 500,000 of their receivables, so what they do? They just credit accounts receivable. So whatever the amount is of the receivables that you're selling, credit receivables for. What is the factor going to do, seeing as now they're their receivables? Debit accounts receivables. And notice they show notes receivable in parentheses. It could be for the same thing for notes. You can sell your notes. Okay? All right, so then what? You figure out how much cash you're going to get, huh? So you're going to receive cash for your receivables when you sell them, and the factor's going to give up the cash. Well, that's pretty straightforward. That's not bad, is it? So how do you know how much? Yeah, how much are they going to charge you? And what are you going to call that for you? You're getting less than the face amount of the receivables. What are you going to have? You call it a loss on sale, okay? It's loss on sale. Loss on factoring or loss on sale. What are they going to call it? Gain? Well, maybe interest revenue, maybe factoring revenue. Either one's fine. I know they call it interest revenue, but a lot of people call it factoring revenue. So it's not really interest revenue because they didn't really loan you money. Is it? I know it's what it says. I disagree on that. Do you think it's interest revenue if they didn't loan you money? Yeah, but they call it what they want. I think it's factoring revenue. But in any event, I'll take either one, of course. Okay? Because you can't disagree with Kiesel. I'll give anything to that, right? So It's like disagreeing with God or something, so, no, not quite, but it's the Bible you have there in front of you for accounting. It's not quite that bad. Okay, but anyway, so factoring revenue, interest revenue, I guess either one's okay with me. All right, so that's the charge they're gonna have. How do they decide how much that charge is? How bad are your receivables? Right? How bad are they? Okay, so how much risk are they taking? What'd they do in this problem? What'd they say that was?
3% of the amount of accounts receivable and get 5% of the accounts receivable.
For the 5% still for what? That's for a reserve. Notice that's due from factor, due to the company, due to the textile company. What's that?
So if they get all of the money, they give that back to them?
Yeah, so they've kind of got an allowance for doubtful accounts, sort of. They can call it that, but that's sort of what it is. So yeah, that's to protect them. That's a reserve, a cushion, right? So they're protecting themselves even more. So that $15,000 loss for you and 15 revenue for them, they're going to get that no matter what. If they collect everything, they still get to keep that, right? But just to protect them, right? Or if they collect 460, they get to keep that, right? They get it anyway, okay? But to protect them, what they did was they says, well, okay, we want to have a cushion of 25,000. So we've got due from the factor. So the factor will give this to us if they collect it. If they never collect it, we never see it. Everybody got the idea? How do they decide how big this is? How big, or how bad, rather, are your receivables? Both of them are how bad your receivables are. Got the idea? So they're hitting you for 8% between the two, okay? And it's all negotiable. It's going to be due to the company over here, right? Due to this company, textile company in this case, 25,000. So what they're going to do is just subtract the 25 and the 15 from the 500, and they will give you 460,000. Everybody good? It's not a very big deal, is it? Okay, let's do 3 scenarios. Let's say they collect the entire $500,000. What will happen if they collect the entire $500,000? How will that work?
So on the factor side, they would credit the accounts receivable.
Yeah, who's collecting the receivable? The factor or the company? Yeah, the factor is, they own them. Excellent. So that's the first thing that would happen. What would happen over here? No entry. Now what? What would happen next? Yeah, they owe you the 25, and they'll give it to you because they collected it all. So what'll the factor do? Write me a check? Write the company a check? I'd rather it not be me. Due to company 25 and debit what?
Due to company 25.
Yeah, this is really straightforward. It's gone. Everybody see it? Well, the company do, of course, seeing as they get the cash. Credit. Due from. Very simple. Everybody happy? Okay, so there's the example of what you would do if they collect all of it, right? That was collecting all of it. Okay, let's change it a little bit. Let's say, and was this with or without recourse, guys? This is without. Okay, and we're going to need to do with too. So we get some combinations here that make it a little more fun, I guess. All right, so let's try it. What happens if they pay us something like, let's make it 480,000. They collect 480,000. Okay. So this was 500K. let's do 480K. What do you think that one would be? Go ahead and do it. He's got a little tough for all this stuff. Not a lot, but a little. Let yourself think about what you do. How big a cushion do they have? 25. How much short were they? 20. Are they okay? Yeah. As long as they collect 475, the factor's just fine. Right? What would they do? And then what would the company do, of course, too? This side was the company, right, guys? This side's the factor. You got it? How much cash did the factor get? 480. What would they credit?
Accounts receivable for
'Cause
500.
they could, but probably just 480 at the time. Okay, probably. Okay. Then what would they do? They still have 20 receivables and they're giving up. They don't need any bad debt expense.
Would
They have a due to company of how much? Due to company. How much do they have in there? 25. How much can they take out? Can I take out the 25? I don't owe them anything. I'm not going to give them anything. Well, yes, I am. I'm going to give them back what? I'm going to give them 5,000 cash because I collected 5 more than my cushion, right? Or 5 into my cushion. And what's the other 20 going to be? Accounts receivable. So you could have put the 500 up here like you were saying, it'd be all right? And then you'd have the 20 debit. Okay? Now what would happen over on the company's books? How much cash did they get? So no entry first, right, on the first part. No entry on that one. So up here, no entry, right? But then they get the cash, how much? 5,000. Ah, good. And due from factor how much? The whole 25. And the factor would give me back what? $20,000 of accounts receivable that they could not collect and don't care if they ever do, because they don't need to. Right? My problem. Here, have your receivables back. I got my money. I'm happy. Right? What the factor wants to do is make their $15,000, right? That's what they're going to make in the deal. Okay? Everybody got it? Okay, that's all they can make. Okay? So let's make it worse. Let's say that it's, let's go down to 470. Let's have them collect 470 of it. And now they're going to give up at 470. And they're not happy. Okay. So let's say they collect 470,000. And this will be anything less than what? How much do they want to collect minimum? 475. So if they collected 470, they're not going to be very happy. No entry on the company's books, right? Well, what's going to happen on the factor's books? 470, good. And credit? And now they're going to give up. Not happy. A whole bunch of time goes by, they're giving up. What do they do? Yeah, they're going to have a problem now, aren't they? or it can be a bad debt. They might have had an allowance set up on these. They could set up an allowance on the receivables, and it could go against their allowance account. Or it could be a bad debt expense, or it could be a reduction of their financing revenue, right, their factoring revenue. They can do that if it's in the same year. Okay, they can reduce how much they earned on factoring. Okay, so what are they gonna have to do? How much account receivable do they need to get rid of? 30,000, everybody agree? What else do they wanna do? That's the whole 500, right? Get rid of the whole 500. They wanna debit what? What do they still have to get rid of? Yeah, due to company. They're certainly not gonna give the company anything, right? Because they didn't collect enough. Everybody getting it? Just let yourself think through them, you're in good shape. 5,000 goes to what? This is without recourse. What is it? It's a loss or a reduction of factoring revenue. You might offset it against factoring revenue or interest revenue if you insist on calling it that, like the authors did. Right? I think it's wrong. See why I think it's wrong? They don't loan any money. Right? But anyway, okay. So a lot of people call it interest revenue. All right, they think they're lending money. So we can reduce factoring revenue, or what else could we go to here? Loss, right? Okay, some sort of a loss or a reduction of revenue. Okay, bad debt expense, something like that. Okay, and then what will we do on the company's books? We still have to do something. No, they don't. They didn't give me. Oh, we got to get rid of the due from though. Oh my, they're not going to give them the receivables. They're gonna wait and see if they ever collect them. So they're giving up. Uh-oh, those receivables just got written off, kind of. They're going to hang on to them until they get paid some more. They're never going to give them back to us ever. So the 25,000 comes out just like it had on all the other ones, right? See it there? Due from factor still going away for 25. What's it going to be to us? Oh my, we don't just have a 15,000 exposure. How much exposure might we have? See, they gave us the receivables, right? But if there's if they don't collect enough, they're not going to give us the receivables. What do you think this might be? Loss on factoring. If the real deal falls apart completely, and you have to decide if you're ever going to collect it, so there's some judgment here, right? Are they ever going to collect any of those receivables? If not, it's loss on factoring. It can't be more bad debt expense, right, for us? Because we don't have any receivables anymore. So maybe our exposure is up to what? In this case, the whole 40,000. You're on the hook for the 15. You're going to for sure pay that, right? Sell these receivables, but it might cost you up to another 25. Okay? So do you care how big that reserve is that the factoring company hangs on to? Oh, yeah. And it gets worse with recourse. So, assuming you have any money. Because what will they do if it's with recourse? They'll come after you for it instead of having a loss themselves. So let's give that a shot. Just for fun. Oh, God, this is ridiculous. So take a look. So you have to count through these two times and think about them, get it straight in your head. Okay? How does this stuff really work? Okay. They've got one with recourse over somewhere. I think 369. 369. There it is. With recourse. The bottom square, entries from sale of receivables with recourse. What's the only change? This is the same deal. It's the same deal, right? Press textiles and commercial factories. It's the same one, except it's with recourse. Notice for commercial factors, it's exactly the same entries. Oh, what's different on press textiles? So let's do the company. And let's do the factor. Isn't this stuff fun? Maybe overstatement. What's the deal? At the time that we sell them the receivables, this is with recourse, which simply means they can come back and try to get the money out of me, right? If I sell them my receivables with recourse, right? Without they can. What would it look like at the time that I factored the receivables with? Exactly the same entry, wasn't it? For commercial factors. They got the receivables, debit accounts receivable. It was 500,000. They charged me what? Factor revenue or interest revenue was 3% up front, right? And if these are, by the way, it's only going to take a month to collect these receivables. Wow, that's a big charge, isn't it? Even if they collect all of them, right? They're still hitting me for $15,000 on how big a loan? They're only giving me how much? 460, and then they're going to give me the rest of my money after they collect it. So what's 15,000 divided by 460? That's the best case. That's the cheapest it'll be if all my customers pay. Times 12. Right? Yeah. Okay. So that's if it's a 3%, right? Fee up front. Okay. So anyway, yeah. So and that was more than 3, right? Yeah. So and a little more than 36%. About 40%. Okay. Anyway, yeah, pretty ugly. Still legal. Factoring revenue they earned is how much? Is it 15? And then what they have? What's the other one called? Due to the company, right? It was 5%. Whatever the percents are, just use them, right? It's the percent of the full face amount of the receivables, right? Good. And then cash. So nothing changed here. You know why nothing changed? They based their fees they charged you, the 3% and the 5%, they based that on how bad they thought the receivables were. Might you know they're even worse than they thought? Asymmetric information. We know how bad they are, they don't. We're selling it to them. We'll take whatever we can get out of them. But we think it might be even worse. So what do? We're going to debit the cash for what we get. How much? So this is really pretty simple, really, once you get your head around it. It looks complex, but it's not, right? How much are we going to credit accounts receivable for? Obviously, the full 500,000. Okay? How much is due from the factor? Obviously, how much they owe us? 25,000. Now things are going to change. What's the deal? I think I might have a bigger problem than what? I think they're not only not going to get the 25,000, but it might be worse. I'm never going to see the 25, maybe, right? But maybe I'll see part of it, right? But I don't think I'm going to see all of it. I don't think I'm going to get all of it. How much do I think I'm going to be short in that little example? 6. The recourse liability is the portion of those receivables we think they're never going to collect. Recourse liability. So what I'm doing is I'm saying I'm not really going to have to give them 15,000, right? I'm not giving up just 15,000 of my receivables. They're never going to collect another 6,000 of it. So the most they're going to get, I think, is 494 apparently, huh? Okay? So therefore, they're not going to give me my whole 25,000. So what's my loss on sale really going to be? Got it. It's the 15 I already had, right? For their fee, right? Their factor revenue, that was my fee. Okay? So my loss on sale is 15 plus the recourse liability. That's all it is. Okay. So now you guys try this. Just because it's late and your brains are tired, it'll be fun to torture you, I guess. Okay, let's say they collect the whole $500,000. Nobody expects, or well, the company doesn't expect this, but let's say they get lucky. Collect 500,000. Do that. You do on both sides, do all the entries. Okay. have some entries they like? They didn't show you these in the book, did they? I didn't show you the other ones, they did all of them either. What'll the factor do first? Debit cash, 500 grand, and credit accounts receivable, 500 grand. This is too easy to believe. It's exactly the same as the one we just did without recourse. And then they're going to do what? Debit due to company. How much? The whole 25. Making sense? Credit what? Yeah, they're going to send it to them because they collected everything, and they're done, aren't they? On the first one, no entry, right, guys? They're not collecting the receivables, of course. Company's not. Then what happens? They get the cash, don't they? Credit due from factor? Oh, well, that's just the same. Are we done? Or not? We have something strange left on our books if we're the company. Got to get rid of the recourse liability, guys. Just let yourself think, you guys, and you can do this kind of stuff. I kind of like this because, you know, developing you guys as accountants, you have to sort of keep track of where you're at, and the next step, and the next step. What have I done? What do I need to do next? What makes sense, right? So yeah, that recourse liability is sitting there, isn't it? You got to debit it for $6,000. What are you going to credit?
Loss on sale.
Yeah, we made our loss too big by the 6, didn't we? Because we guessed that we needed a recourse liability and we didn't. So I'm going to reduce the loss. So I'm going to credit loss on sale, or if it's in the next year, it'd be recovery of loss. Credit to it. Got the idea? Or if I'm doing it year after year after year and I have more losses, I could offset that. Loss on sale. Excellent, guys. Okay. Did you guys have that? On your own? Good, good, good. Okay, let's do, that'd be another good number. What did I use before? 480 did I use? Yeah, go ahead and do 480. That's all right. Try 480. By the way, I didn't cover allowance for doubtful accounts in here. We did that in chapter 3, right? Will I have it quiz and test and final? Of course. Yeah, so show up every year. It's just the same stuff. A little more detail. Go ahead and record those. Easy? Kind of? Remember to handle the recourse liabilities all you got. It's really different. I'll do the hard part. Debit cash 480. That's funny. Credit accounts receivable 480. Now what do you want to do? No entry over here, of course, right? They're not collecting the cash. Now what? Due to company. Assuming they're giving up, right? Did they collect all the money they expected to collect? Careful. How much did they expect to collect? 475. So they're still okay. Okay. So due from company 25,000. Good. Okay. And cash of 25,000. And,
Okay, what did you
We'll
say,
see.
5,000? Okay, fine.
is he gonna give him 25?
But when you only give them 5,000.
Oh, yeah, I agree.
then it comes
Yeah, I
receivable.
think so. That's too much, isn't it? Cash is only gonna be 5. I agree. Cause you want 475 for you, don't you? Okay, good. And what's the rest? Accounts receivable. I'm gonna give them back their receivables. I got all the money I want. It's their problem to collect the other 20, right? Okay, what are we gonna do on the company side? Debit cash for 5,000. Or if you wanna give up, go to allowance, right? Maybe, or write them off, something. Wanna do that? Did that work? Doesn't do anything else?
It's a credit for the current factor.
Of course. For 25? So that's what's in there? Are you done? No. What are you gonna have to do? No, well, this wasn't so hard. How much? And now what? You got 5,000 cash. Were you expecting to get 5,000 cash? So you're gonna reduce your loss? You think you really would? These accounts receivable aren't collectible, are they? What do you think? I got a debit recourse liability. What do you think? You really think you have less loss? How about doing this? And saying, you know what? I already recognized loss for part of that I expected to never get back. Let's just make this be, what would it be, 14? Yeah. 19 and 6 is 25. I think I did. 3 debits and credit. You think that's better? Because I'm probably going to write these off later anyway. And the whole point is, I thought I wasn't going to get it all. Okay? And then when I don't, I'm not shocked. Okay? Let's make it worse. Maybe it's worse. One more. Okay? Let's say that they collect, they were expecting at least 475. Let's say they only get, what was the other number I used? 460 before, was it? 470? Let's do 460. Let's make it even worse. They collect 460. Ah. And you tell there's a whole variety of ways that you might record this loss, either as a loss, bad debt expense, you know, going against your allowance, all kinds of different things, right? More factoring expense, right? More factoring loss. Okay, how about if they collect the 460? Okay, the easy part first. Debit cash 460, right? For the factor. Credit accounts receivable 460 for the factor. Okay, what do they want to do now? God. They're going to get rid of the due to company, right? How much? 25,000, so it's all gone, okay? They're not going to credit cash or anything, are they?
Accounts receivable for 40.
They want to write up the 40? Here you can have them back, maybe? What else might they do? See, they're not exposed to the loss here, are they? Unless they think they're never going to collect it. What's it going to be? Due from company. How much? How much were they short? What did I say, 460, and they expected to have 475? How much are they short, gang? 15. It's a miracle it balances. That's what I want. Now, the company owes the factor 15,000. Now, that's assuming they think they're going to collect it, right? Otherwise, they might go to a loss. Okay? But yeah, they're going to try to collect it from them. Guess what the company has to do?
Increase the due to company, the due to factor.
Well, they have a due from factor to get rid of first. So won't they get rid of their due from factor? This is getting ridiculous, isn't it? That 25 still gotta go. Do they still have to get rid of their recourse liability? Yeah, I think so. Get it off their books. Now what? Do they have a due to the factor? Yeah. How much is that? It's 15. Wait a minute, that's a credit. 19. Anybody notice that? Due to is of course a liability. Due to factor. For what did I say? 15? That's 40. Wow.
Increased loss on,
Factoring.
yeah.
Yeah. Is it all loss? 40 less 6? How much loss have they recognized so far? They got 21,000 out of the 500, right? How much more are they going to have? See, this limited it by 6 at least, because it looked like a 40 loss, didn't it? Right? More. 500 down to 460. Okay, so what's it going to be? This is 40 less 6 is 34. Yeah, but you probably wouldn't put them back on your books. You just try to collect 34,000 loss. Yeah. Okay. They just got clobbered. They're taking the full risk. This is assuming they can actually afford to pay that $15,000 to them, right? Okay. There you go. What a mess, huh? Never let your business get there, okay? Never let your business. Yeah, we're losing 2 minutes early. Sorry, seeing me on the video. My wife's excited. Isn't that sweet? Anybody else want to give me a test? I have 3 of them. Another 9. You guys